Very good. The question is whether the plant overheads are included in the cost of sales. Now, interestingly, I have delivered these programs in more than 50 locations across the globe, including Americas, Europe, Russia, Asia, Middle East, Africa, and I have had an opportunity of reading the financial statements all over the globe. Now, everywhere, the cost of sales terminology is used in the same way. Really speaking, it is not cost of sales. Really speaking, it is cost of production. But globally, this term that you are seeing here as cost of sales is used as a cost of sales only. So since you have raised this question, for your understanding, remember what is referred as cost of sales, really speaking, is not cost of sales, it is cost of production. But since globally this is how this terminology is used, we have to abide by that, because if we start using and terming it as a cost of production, technically we would be right, but we might create confusion in the minds of the people, because we may understand this as a cost of production, but others may not understand this as a cost of production. They would still understand as a cost of sales. So that is how I would answer to your question. So in to sum it up, cost of sales should include, besides the cost of production, also the cost of administration and the sales and marketing expenses, isn't it? But globally, the terms which are used are as we are discussing here in this session. I hope this answers your question and your doubt.
Okay, sir.
है ना? So your doubt is very good, but remember there's a terminology which is used globally, and we have to follow the same terminology. Otherwise, we might end up in creating confusion. But your question and your observation is very good. I must appreciate that.
Okay, thank you.
All right, good, very good. So let's move forward. Now, from the current operating income, which is also known as in brief COI, which is also known as EBIT, earning before interest and tax. What we do, we deduct the restructuring cost. So what is the meaning of restructuring cost? The meaning of restructuring cost is in case if a company is getting restructured, and on that restructuring, so restructuring would mean if a company is going for merger, amalgamation, acquisition, and things like that. So whatever expenses which are incurred on this restructuring of a business is known as restructuring cost. Impairment losses, I'm sure all of you would be aware, but let me very quickly tell you as to what is impairment loss. And please pay attention. Typically, in a business, we use different assets, and on those assets, we charge depreciation in a systematic manner spread over the life of the asset. But sometimes, please remember, it can happen. Value of an asset can come down drastically because of change in technology or because of any other thing. So if the value of an asset has gone down more over and above the amount of depreciation that was applicable on this asset, the excess of the reduction in the value of asset over the amount of depreciation is referred as impairment loss. Is referred as impairment loss. So what we do, from the current operating income, we deduct the restructuring cost that I have explained to you. We deduct the impairment cost that I have explained to you, and we deduct other exceptional operating expenses or gain. Now, what is the exceptional operating expenses or gain? It means certain expenses that do not happen regularly, that can happen once in a while, right? So once in a while. So all these expenses, when we minus from the amount of EBIT, what we get is what is known as operating income. So remember, one is current operating income and other is operating income. So what is the difference between the current operating income and the operating income? The difference between the current operating income and the operating income is the total of restructuring cost, impairment losses, and other exceptional operating and expenses or gains. So operating income, please remember why it is called as operating income. It is called as operating income because this is the income that you are generating from operations of your business, and that is why it is referred as operating income. Operating income is why it is called as operating income. No rocket science, it is very simple. Operating income is referred as operating income because this is the income, as you can see and realize that this is the income which is getting generated from the operations of the business, and that is why it is known as operating income. Now from this operating income, friends, what will you do? From this operating income you will deduct gains and losses on securities. Meaning what? Meaning we as a company, whenever we have some surplus funds available with us, what we would do? We would not keep these funds in the bank account, because if we are keeping the surplus funds in the bank account, we are not earning anything on that money that we are keeping in the bank account. So what we will do, we will put this money into the debt fund or into the equity, right, somewhere, so that we are able to earn something out of it. So whatever gains or losses that we earn on these securities, remember, is not our operating income, isn't it? So the income that the company is earning from the investment which it has made in the shares or debentures of some other company, that income is not company's operating income. It is company's non-operating income. How do you differentiate between the operating income and the non-operating income? Answer, of course, is very simple. Operating income is the income which is getting generated from the operations of the company. So the income that we generate from the sale of our products and services is our operating income. But the income that we generate from the investment that we make in the securities of other company or the government bonds, that income is our non-operating income. And why it is known as non-operating income? It is known as non-operating income because this income is not coming from the operations of the company. This income is coming from the non-operations of the company, and that is why all this gains and losses on securities, gross financial charges. So the interest that we pay, remember, is not our operational income. It is not our operational expense. Please pay attention here. It is very important. Interest we pay on the loans that we have taken. Is it our operating income expense? It is not our operating expense. Please pay attention. Why? Because we pay interest because we have borrowed money. If we would not have borrowed money, if we would have used our own capital, then we would not have paid interest. And therefore, interest is not an operating expense. Interest is known as financial expense. So that is why from the operating income, besides deducting gains and losses on securities and gross financial charges and financial revenue, so it is possible that sometimes you can put your money into fixed deposits with bank, and bank will pay you some interest, and that is the financial revenue that you are earning. Exchange rates gains and losses. So ours is a global company, and we always have the exposure to various currencies, and since we have exposure on various currencies globally, in certain cases we might incur some loss, in certain cases we might incur some exchange gain, and that is our exchange gain and losses. So you can very easily understand all these four items that you see here are not our operating income or operating expenses. These are our non-operating income or non-operating gains or losses, and that is why from the operating income we will deduct all these four items which are referred as net financial result, and what we get in our hand is known as profit before tax or before tax income. So you call it profit before tax, or you call it before tax income, or you call it earning before tax, EBT. They all mean the same thing, but in our company we refer it as before tax income. And so that is how you come to the figure of before tax income. Are we complete as far as the income statement is concerned? Not yet. Not yet. Why? Because we still have one step to go. And what that one step is, that one step is from the figure of before tax income, we will deduct the income tax. Remember, we are a company liable to pay income tax on the income that we earn. Which income? Income before tax income. So on this income, we pay some tax depending on the different geographies that we are in, depending on the tax rate and tax provisions applicable in those geographies. We will have to work out as to how much the income tax that we have to pay, and that figure we deduct from the before tax income, and what we get in our hand is known as net income. Now this is known as net income in our company. Otherwise, it is also known as net profit. It is also known as EAT, earning after tax. It is also known as PAT, profit after tax. So, and this is also known as bottom line. This is also referred as bottom line. So this, friends, is the complete understanding of the income statement. So before I go over to the next slide, in case if any one of you have any doubt, any question, please go ahead and I would be happy to take your doubts, take your questions.